investors become pessimistic and U.S. economic optimism falters. IBD/TIPP optimism about the near-term outlook for the U.S. economy dived to an 18-month low as Omicron case levels exploded and inflation continued to hit generational highs, the new IBD/TIPP poll finds. The major shift came among investors, who are suddenly feeling more bearish about the U.S. economic outlook than they've been in more than 5 years. The overall IBD/TIPP Economic Optimism Index, an early monthly read on consumer confidence, sank 3.7 points to 44.7, firmly downbeat territory. Readings below the neutral 50 level reflect pessimism. Big swings in sentiment have become common as Americans have navigated pandemic-related ups and downs, along with hot and cold fiscal stimulus. Yet the broad economy and job market appear to be striding ahead. The unemployment rate tumbled to 3.9% in December, the Labor Department reported on Friday, though the data largely preceded the Omicron surge. Investors turned bearish on U.S. economy as the Federal Reserve turned more hawkish. Treasury yields jumped and the stock market, particularly the tech sector, took a beating. The broad U.S. economic optimism gauge dived 9.6 points to 48.8 among self-described investors. That's the lowest level since September 2016. The Nasdaq suffered its sharpest four-session loss since September 2020. Amid the IBD/TIPP polling period, the Nasdaq tumbled below its 200-day line Monday morning, rebounding to close slightly positive. Make sure to read IBD's daily afternoon The Big Picture column to get the latest read on the prevailing market trend and what it means for your trading decision. IBD/TIPP counts as investors those respondents who say they have at least $10,000 in household-owned mutual funds or equity. Investors remain far less downbeat than non-investors. Among non-investors, the IBD/TIPP index lost 0.8 of a point to 42.7. U.S. Economic Optimism Index component. The IBD/TIPP Economic Optimism Index is a composite of 3 major subindexes. They track views of near-term prospects for the U.S. economy, the outlook for personal finances, and support for government economic policy. In January, the 6-month U.S. Economic Outlook Index slid 4.9 points to 37.9. The lowest level since July 2020. The economic outlook reading for Democrats tumbled 9.4 points to 50.2. Among independents, the reading slid 2 points, 31.9, while Republicans were fractionally higher at 25.5. The personal finances subindex fell 2.6 points to 52.3, well off its peak but still reflecting modest optimism. The gauge of support for federal economic policies subindex sank 3.6 points to 43.9. Biden job approval relapses as Omicron surges, stock market slump. Inflation fears stress American. The IBD/TIPP financial-related stress index rose 1.1 points from December to 66.2. The second highest reading since April 2020. Readings above 50 indicate rising stress. The financial stress index fell to a COVID-era low of 56.8 in early April, after most Americans received their third stimulus check. The surge in inflation has likely contributed to rising financial stress. The consumer price index rose 6.8% from a year ago in November, a 39-year high. The IBD/TIPP poll finds that 86% of Americans are concerned about the path of inflation over the next 12 months, up from 84% a month ago. Wages have surged as employers bid for scarce labor, yet they're still not keeping up with inflation. The December jobs report showed that the average hourly wage rose 4.7% from a year ago. Despite apparent labor market tightness, the IBD/TIPP poll finds that 40% of households have at least one member who is out of work and looking for employment, down 4 points from November. A steady 35% are concerned about job loss in the household. Factoring in the overlap, the share of job-sensitive households is currently 48%, down 7 points from last month. The January IBD/TIPP poll reflects online surveys of 1,308 adults from January 5 to 9. The results come with a credibility interval of plus or minus 2.8 points. Please follow Jed Graham on Twitter at IBD_J Graham for coverage of economic policy and financial markets.